Welcome to the Transparent FX Academy. I'm Nick and I'm a top author trading view with over 190k reputation points. In this video, I'll speak about gold. And as usual, to keep the video as educational as possible, first I'll cover the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, which is what the big players in the market are doing and how they're moving and shifting their orders, which you see right here. And by the end of the video, by using the combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. So without further ado, let's jump straight into it. Starting here from the monthly time frame, what we can see is that we have a market which at the moment is in a very strong uptrend. The market has been creating a series of monthly higher highs and higher lows, and every single time this push to the upside was fueled by institutional longing. So every time we had an impulse and correction, new institutional longing happened, pushing the price even higher. And we will speak about institutional longing in just a few moments when we move to the commitment of traders analysis to see how institutions are shifting their positioning. But for now, let's keep in mind that we have a strong uptrend here in the monthly time frame, and this uptrend is fueled by this institutional longing. We also have to notice that all this huge uptrend is actually developing as a breakout away from a strong historical structured zone. In fact, from here, we can see how multiple rejections to the downside were created. This zone was respected and continued acting as strong supply and resistance from a monthly perspective for multiple years. Starting from 2020 all the way up to 2024, this area has been acting as a strong multi-year supply and resistance zone. However, recently the market managed to break above the zone with this impulse to the upside. And what we know is that previous resistance, once it is broken to the upside, becomes support. So the market retested here the level as previous resistance turns support, and all this massive uptrend fueled by that institutional longing actually started developing. And so far, we had multiple impulses and corrections along the way. Now, the last move was an impulse. The next logical step would be to see first a correction and then the continuation to the upside. That is how an uptrend develops, a series of impulses and corrections. So let's keep all of this in mind and drop down here on the weekly time frame. Now, from a weekly perspective, the price action as well here is quite clear. We can notice how we had first a strong impulse, then the market started consolidating in this triangle formation. A triangle formation, in other words, is a wedge. Simply, the market is creating higher highs and higher lows at the same time. After a wedge, I'm sure you saw that happening already many times, you expect the market to break out to the upside, which is exactly what happened here. We had the impulse consolidation in the form of a triangle formation and then breakout to the upside. For sure, a pattern that you have seen many times already happening in the market. We can also notice that the market at the moment here on the weekly is in a clear uptrend with the creation of these weekly higher highs and higher lows. We can also notice that we have an impulse followed by a correction. Now, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse leg. This shows us how we have the 0.3 to 50% and 0.618 Fibonacci retracements all lining up in the same area of price, creating strong structural demand and support around this area. And we can see that in fact the market has been moving sideways so far inside of this correction zone. So to see the price action more clearly, what we have to do is go down on the daily time frame. Now, from a daily perspective here, things get even more interesting. Now, I did speak about gold just a few days ago. I spoke about it when the market was around this area. I explained all the reasons for which I was expecting this rejection to the upside, and that is in fact exactly what the market gave us. Then we had this correction to the demand and support zone, and from here I made another breakdown explaining all the reasons for which I was expecting this rejection to the upside, and again, that is exactly what the market did. And by the way, I will link in description these previous analysis So you can go and check them out for more free education. But before we dig into more details into what we have here from a technical perspective, which will be quite interesting, first, let's go and see what we have when it comes to the commitment of traders, so what the big players in the market are doing on gold. Now, first of all, we have to look at the net positions. What we can see is that we went from 161.2K up to 174.1K net position. So in the very short term, institutions have moved back to the bullish side of gold, increasing their net positions, meaning that the difference between longs and shorts from an institutional perspective has moved to the bullish side, so to the long side, with institutions currently holding 234,000 longs compared to only 59.9K shorts, so aggressively positioned to the bullish side, which comes as no surprise if you think about it, because we have already seen that on the monthly time frame, the market is in a strong uptrend. Now, going back to the technical aspect of the market and keeping in mind that institutions are starting to shift back to the bullish side, which are the important structure levels at which institutions could continue increasing their net positions, so adding more longs. Now, what we have to really keep in mind is that at the moment the market failed in holding this level. This level, the market immediately after reached it, started rejecting it to the downside. So we have structural resistance at this zone, which is the previous daily high. If the market will manage to break above that zone, that is where things get interesting, because a break above this level would make this previous resistance become support. So if the market does break on the retest of this previous resistance turn support, this is where we have good probability of seeing more institutional longing, because if from here the market will just continue lower, nothing really interesting is happening. The market is just failing to hold this support level. But if the market will break above that zone, that is where things get very interesting, because at that point, after the break, this previous resistance would become support. So if the market would go and retest the previous resistance turn support, there is good probability of seeing strong institutional buying around this zone, further increasing the probabilities of a potential rejection to the upside away from this level. And by the way, if you still haven't, make sure that you join my free Telegram channel, which you find linked in description, so you never miss new updates. Now back to the analysis. So as my students know very well, trading is reactive and not predictive. The monthly, weekly, and daily time frames combined with the COT data, those are the best time frames when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best time frames for that are the intraday time frames, so 4 hour and lower. So if the market would break and retest, and the market would shift from an intraday bearish to a bullish market with institutional longing, I definitely wouldn't be surprised at that point to see a potential rejection to the upside away from this level. That definitely wouldn't surprise me. Instead, if the market just fails to find support along the way, a breakout to the downside is inevitable, and at that point, simply new structure would be created, and I will try to obviously make an update also here on YouTube. Now, if you want to learn more, I really recommend that you go and check out my website, which is linked in the description, because what you see me share here on YouTube is actually just the tip of the iceberg. In fact, if you head over to the website in the description, you will have the possibility to join the best trading program on the planet. You will gain access to all the courses ranging from the very basics of charting all the way to the more advanced topics like building automated trading strategies using the MQL4 programming language, building portfolios of strategies using quantitative finance tools like the Quant Analyzer, and much more. You will have the possibility, in fact, to gain access to the trading station software with the Telegram notifications integration, one-on-one private mentoring directly with me, the COT data software, which often you see me use directly in my YouTube videos, on all my platforms actually. And if you scroll down, you will see that you also have the possibility to get the integration. So all my EAs, which you find here presented one by one directly on the website. And you also have the possibility to gain access to my live trading show. So I live stream of all the trades on my live account as they're opened, closed, trade, and obviously managed. And if you continue to scroll down, you will see that you have the possibility to join just after here the testimonials and gain automatically access with the email and password that you will create during the checkout process. So I really suggest that at least you go and check it out. The link is in the description, and I will see you in it. If you enjoyed the video, make sure to click on the like button. Also, let me know in the comments below any new pairs that you would like me to cover in my next videos. Also, any questions you have, leave them in the comments below. Subscribe to the channel so you never miss new updates, and I will see you in my next video.